Hi, folks. This is Big Mike Zlatnik, and today we're going to discuss an advanced topic: how to use real estate depreciation to offset other income. And an immediate disclaimer and waiver. Obviously, this is for informational, educational purposes. Consult with your attorney and CPA professional before making any investment decisions. Going to cover some of the very powerful, very advanced topics. Not for everyone. Something that folks may choose to proceed. So let's kind of cover how it works. So you get, let's just say, a lot of depreciation through bonus depreciation on a multifamily syndication. Through accelerated depreciation, bonus depreciation, you put in 100,000, you get 200,000 out of it, or something along these lines, large amount of depreciation. How do you use that depreciation, that loss, to offset other income gain? And it is not for everyone. For most folks, that loss, depreciation-driven loss, is a passive loss, and they cannot use it to offset active income from their business or trade. However, there are exceptions. The exception is real estate professional, and real estate professionals is a designation that investors need to achieve every year. It's not a one-time designation. It's every year if you want to stay as real estate professional. And again, we're discussing very technical requirements, but to achieve real estate professional, that needs to be your primary trade. So you cannot be a doctor spending 1,000 hours practicing medicine and be a real estate professional achieving 750 minimum hours requirement. So the requirement is 750 hours a year, but it has to be a primary trade, meaning that you cannot do something else where you spend more time and effort on that business or trade. So it has to be primary trade, meaning that you could do 1,000 hours a year real estate professional, and you can do something else for 500 hours a year, right? That's okay to achieve real estate professional status. So once you achieve the real estate professional status by making it your primary trade and spending those hours on the business, you also need to have enough hours spent on rental, materially participating in rental activities. So what does that mean? It means that you need to own rental real estate, basically real estate that you own somewhere not far from your home where you live, because you're going to need to spend 500 hours a year or more materially participating in the rental activities, so rental properties. So that just means that you're going to have to sort of self-manage certain investments. It doesn't mean you have to self-manage everything, but you're going to have to clock 500 hours. Where do you clock 500 hours a year if you don't own a property? You cannot. And if the property is too far away, you can't get those hours as well. So you're going to have to own rental house, duplex, triplex, quad, small multifamily, small commercial, something that is not too far from you where you are. Not too far, meaning that an hour drive, within an hour drive, could be a little bit longer, but it's not 1,000 miles away. So otherwise, it's practically very difficult to do. So what I'm kind of describing is just practical implication, how it could work. And by the way, couples have a really, really powerful situation where one of the folks, one of the spouses, could be a doctor, a lawyer, another trade, and their spouse could be a real estate professional. This is the most common scenario. And realtor is not the only way to be a real estate professional. You can own a portfolio of rentals and manage a portfolio of rentals, and you can achieve real estate professional status that way. So people get a license, and they think getting a license gets you a real estate professional. It doesn't. It's the IRS wants to see that it's your primary trade and you're spending enough hours to meet at least 750 hours a year. Of the 750, you need to spend at least 500 materially participating in managing your rental properties. Could be commercial, as I said, could be residentials. There's a whole list of activities what describes material participation. For example, going to the property, dealing with tenants, signing leases, negotiating leases with tenants, dealing with maintenance of the property, dealing with the rehab of the property, and so on and so forth. These are material participation tasks. It's not enough to have a property, and if you are 1,000 miles away and you are doing this stuff over the phone, it's very difficult to get there. In case of an audit, IRS will come in and give you a hard time. So you need something local. This is the easiest way to think about this, something you can actually deal with. And it has to be rental property. If you're just doing fix and flip, it's not sufficient. You need to own it. It is intended to be as a rental property. So there are other use cases how you get there, but I'm sort of describing the most practical use case that has worked for many real estate investors who achieve real estate professional status, who have 500 rental hours, materially participating in the managing your rentals. And as I said, renovation is of a rental property, as long as the intent is to rent it, is material participation. So managing renovations, being on site, dealing with contractors. And the other interesting part is your commute time to and from the property counts too. Now, an airline flight 1,000 miles away doesn't count, but driving an hour to the property and an hour back generally counts toward the hours you're spending on a property. If you're going to spend 5 hours on a property and drive 1 hour each way, then you spend 7 hours materially participating in, well, again, the activities themselves have to be material participation. So, and then the final step, your real estate CPA, your CPA should know how to do what is known as a grouping election. So they'll group all gains and all losses on your tax return. And I'm not CPA, I'm not going to explain this in greater depth, other than your CPA should know how to do a grouping election, where you have losses generated from the depreciation of the properties that you didn't particularly materially participate in. You just got passive losses from those properties. But because you or your spouse, real estate professional with 500 hours of material participation in rental activities, you can now take the passive losses from depreciation you get against the income and gain from other businesses that you have. And that's the power of this exercise. Again, you could be a doctor generating a lot of income from your trade. Your spouse is a realtor, or your spouse is a real estate investor who owns a bunch of properties where you own it together, but the spouse spends the hours necessary to clock the 500 material participation hours on rental activities and total 750 per year to get real estate professional status. And that in combination would enable losses from the depreciation through the grouping election on the tax return to offset gains or other income. As real estate professional, all income becomes active. So the passive income or passive loss is no longer passive. It now becomes active, and it can be deducted against other active income. I hope this helps. Once again, I'm not a CPA. I don't play one on TV. Consult with your CPA professional or tax attorney to make sure this is done by the book, so you don't get in trouble with IRS if you proceed with this strategy. Many people have executed this successfully and been very, very happy with the outcome. But this is something to keep in mind, as if you do this, you got to do it by the book to avoid potential problems with the IRS. Thank you. Appreciate your time and attention. Until the next time. Thank you.